Remember, folks, the price for the courses goes up on Friday. Check them out, link below. If you listen to our government and the Biden administration, inflation is not an issue. They say that consumers aren't paying more because they can't pay more, because they're not able to purchase anything. That's literally what Jen Psaki just said about inflation, that inflation isn't a problem because people are just saving their money because they can't buy anything. But let's be real, we know that prices are going up. CPI is sitting at 5.4%, which means that consumer prices year over year are up 5.4%. And at an annualized rate on a month-to-month change, we're still seeing inflation above 5%. JP Morgan surveyed respondents, businesses and individuals, and found on October 13th that 42% of respondents believe the United States is, quote, careening towards a stagflationary future. The IMF warned that the prospects for inflation were so highly uncertain, specifically because soaring energy costs will end up pushing up consumer prices in the near term. Wages are skyrocketing as well. In the last CPI report, we saw that wages are increasing at an annualized rate of 4.6%. In earnings reports, the word supply chains, usually in reference to supply chain issues and problems, have been mentioned 3,000 times so far in 2021. Inflation is also coming up in earnings reports as recently as yesterday and today. GE, for example, said that inflation and supply chain challenges are, quote, negatively impacting their businesses, and that they're seeing industry-wide shortages, and had they been able to actually get product, their growth would have been 9 percentage points higher so they could fulfill their orders. As a result, they're seeing prices going up for not only their products, but products that they're, or materials that they're sourcing. And so their priority next year is trying to run a more efficient shop, but on top of that, also raising prices next year. Hasbro says they're also raising prices. Now, they defend this and say that, hey, we're able to retool our lines, though, because we're really used to making new products every single year or working with different sort of input materials, even if we have to find new sources, because toy trends change all the time. So we're used to this sort of retooling, but still prices are going up. 3M says that, quote, inflation is coming faster than anyone thought. And to make up for these pressures, they're raising prices. Jack Dorsey from Twitter just had the following to say, quote, hyperinflation is going to change everything. It's happening. Now, Cathie Wood tried slapping back and saying, hey, but the velocity of money is down. The same thing happened in 2008. Sure, the velocity of money is down, and that is a hedge to inflation. The less a single dollar circulates around the economy, the less inflationary pressures we have. However, Elon Musk replies and says, yeah, I don't know about any of that long-term stuff, but, quote, short-term, we are seeing strong inflationary pressures. The Federal Reserve Bank of San Francisco says it's all because of the American Rescue Plan that led to a substantial amount of higher inflation and the supply chain shortages that we're seeing now because people had more money to spend. Ned Davis research suggests that overall inflation at 5.4% year over year and slowing growth makes it feel like we're heading towards inflation. Sorry, stagflation. And stagflation's not good. Since 1960, Goldman Sachs says there have been 41 quarters of high inflation and weak economic growth. That's stagflation. Lots of inflation with stagnating growth. During those periods, the S&P on average returned negative 2.1%, well below the average of 2.5% growth for all quarters. High inflation of the early to mid 70s was also ultimately solved through, quote, a painful series of interest rate hikes and recessions that the US was then finally able to get through. The Bank of England is so worried about inflation that JP Morgan thinks the Bank of England is going to begin raising rates earlier than expected this year rather than next year. And this has some folks saying, hey, it's time to invest in companies like 3M or Vulcan Materials or Procter & Gamble, typical consumer staples that might do well during an inflationary period of time, or just go straight into commodities. Look at aluminum, look at lumber. I mean, these prices are ridiculous. Even in lumber's slow season, and even though we had a pause in the summer, which is odd because that's the busy season in prices, lumber prices fell in the summer after skyrocketing. Now they're skyrocketing again. So folks, what we've got to talk about in this video is first, are we experiencing stagflation? What about jobs? Because jobs and job shortages really seem like they're going to continue to push inflation up. And if we can figure out what's causing the job shortage, maybe we can figure out if we're going to continue to expect to see inflation. And then is there any sign that inflation is actually starting to subside? So let's break this down one at a time. Number one, look, even though growth is slowing, we're still growing. We're growing at elevated levels. We came off running on a treadmill really, really fast, and now we're slowing down a little bit because we're a little exhausted. Basically, that's normal during a reopening, right? So right now, we're still at elevated levels of demand for goods and services, and nobody actually looks at the situation that we're in terms of data researchers who are pointing to, oh yeah, we're in stagflation. Instead, what data scientists are calling this is a different phrase, and it's kind of neat. It's called an inflationary boom. It's a place where people who have money are spending money, and they're spending money even though prices are higher, reiterating that higher inflation. But we still have growth. We're still growing. Again, maybe not as quickly as we were earlier, but we're still growing. So definitely too much growth to be considered stagflationary right now. But wait a minute, Kevin, if we're not seeing stagflation, why are yields going through the roof? I mean, look at the fact that the 10-year Treasury yield saw a peak earlier in the year. Things cooled down, but now it's back over 1.6. The 10-year break-even inflation rate also just hit a record high at the end of October, 2.66. This measures the difference between the 10-year Treasury yield and the TIPS, which is a Treasury inflation protected security bond. And the difference here is often seen as a measure of inflation, right? And so, or potentially the market pricing in for more inflation coming. It's not directly a measure of inflation. And this makes some folks worry that, wait a minute, like, okay, if this inflation is going to keep happening, we got to get out of tech stocks, which, sidebar on tech stocks, it's kind of interesting when we look into the research on this a little bit. Even though when the Treasury yield skyrocketed last time here between February and May, we saw tech stocks sell off, there's an interesting note here. BMO Capital and their chief investment strategist says the following, quote, "The correlation of tech stocks' relative performance to the 10-year yield has historically oscillated from negative to positive. In other words, very, very bad correlation. And they say that there's, quote, no real pattern here. Then they say, in fact, tech stocks outpaced the S&P 500 during 5 of the previous periods of rising rates and rising inflation. And more recently, tech has outperformed the S&P 500 directly since the pandemic. So in other words, F yields just focus on the things that are potentially creating inflation. So we're not worried about stagflation, but we are worried about an inflationary boom, right? Because inflation's not so great. Then disconnect tech earnings potentially from the Treasury yields, but do focus on inflation. And so when we want to focus on inflation, a big thing right now has to be jobs. So let's talk about jobs. Barron's is suggesting that the pandemic changed people's attitudes and priorities. It changed where people lived, and it changed how people feel about going to work. See, COVID isn't the only thing that's affecting people's jobs. Their personalities, their preferences have changed. In high COVID areas, mobility data is increasing in all areas except places of work. In areas where COVID is neutral or at normal levels, public transportation traffic is up, but workplace traffic is down. And if people are worried about COVID, public transportation probably wouldn't be up. And so Barron's is suggesting that the labor market is actually probably far tighter than it appears. And as a result, inflation essentially has nowhere to go but gets squeezed up. And they believe that the Federal Reserve is actually well behind the curve on raising interest rates and tapering. That's because the Fed keeps looking at the jobs report going, well, I mean, we're still, in the 5% range for unemployment. We got to get this down. Let's stay accommodative. But Barron suggests those numbers are wrong, that the pandemic promoted, quote, a record number of business creation, and that business creation is hard to measure in the jobs report. In fact, in July 2020, they report that 600,000 new businesses were created. That's up 100% from the prior year in 2019. Today, we're still creating new businesses at a rate that's 50% higher than before. And economists say that counting entrepreneurs is incredibly difficult when it comes to the jobs rates. Also, the government has this birth-death model that's used to try to establish payroll counts, and Barron's believes that they fail at accurately counting new businesses appropriately in this measure. So it's actually quite possible that more people are working, but that people are working in a different way than traditional measures have been set up to account for. And that household income is already back to pre-pandemic levels. At the same time, we have stock markets and household markets, like housing price markets, at all-time highs, making households feel a little bit more flush with cash. So there's also the potential that there are not only people creating their new business ventures or whatever, but there's also this potential that two-income households, because they feel wealthier, have become one-income households because they can afford to do so. And maybe they can afford to start a business, whether that makes them feel like they're employed or not yet. We're also at the same time seeing more people retire, which is also reiterated by a soaring stock market, which pumps people's retirement accounts and their real estate value. Stimulus help people sock away more money. Savings are at 10% of GDP right now, so there's really enough reason to not go back to work for a lot of folks, people very fortunate that have been able to save or invest during this time, and they don't feel the need to go back to work. Now, we did think that people were going to rush back to work as soon as unemployment expired, at least the unemployment boost expired in September. But at the same time as we took away the unemployment boost of $300 per week, Joe Biden started the child tax credit of $250 per child under 18 and $300 per child per month under 6. So it's not a surprise that individuals are choosing potentially not to work or delay going back to work, or they're living off their wealth while they're starting new business ventures. So all of a sudden you're in this place where, wow, now it makes sense why there are less people working. But add to this, now new vaccine mandates at not only many corporations, but any business that does contracting work for the government or any government office is now requiring vaccine mandates. And this is leading more people to stake sick outs, where people are calling in sick, as a way of protesting that they don't want a vaccine or they're quitting. And so we're actually potentially making the jobs numbers even worse and worse and worse. So child tax credit, making things worse. Vaccine mandate, making things worse. The fact that people feel like they have more wealth and don't have to go back to work, making things worse. The government statistics, probably not measuring new business creation as well as they should, because new business creation is through the roof. And it's even possible that people who are creating new businesses just report that they're unemployed because they don't feel like they're actually working with a steady income yet. So some people report that they're unemployed anyway, even though they've created a new business and they're just trying to start getting revenue coming in. Now, Goldman Sachs is trying to adjust these numbers, and they're suggesting that workers are now more productive, that they're doing more with less. They're using new technologies, Zoom, they're hybrid working at home and in person or whatever, and that productivity is going up. But if you thought it was hard to measure wage data, it's even harder to measure people's productivity. That's very difficult to measure. And so now all of a sudden we're in this place where, wait a minute, wages are going up. There are a lot of reasons reiterating why wages are going up. And according to Barron's, wages are probably not going to slow down their inflationary pace anytime soon, which will probably lead inflation to continue going up. This is why we say we're in this inflationary boom. I mean, consider this. Credit card spending is up. People are really excited about retail. Ironically, people are really excited about brick and mortar. So much so that Macy's store sales were such a blowout that their stock is up 36% in just the last 3 months. At the same time, Macy's and Kohl's only trade for 7 times estimated 2022 earnings. So they look a little bit on the cheap side. Who knows if that'll last though, right? Okay, so we're not stagflating. We're inflationary booming, if that's a word. We're having an inflationary boom. We don't think wage pressures are going to go away anytime soon because of all the reasons that we mentioned, which is not great. So what's going to be the first thing to tip? And is anything even close to tipping? Well, fortunately, the answer to that is yes. There's a little bit of light at the end of the tunnel. Delivery time frames for our supply chain crises are starting to slow their pace of gains. Delivery timeframes in October posted their smallest gain in 9 months, a signal that finally supply shortages might begin to ease. Container prices have also started coming down. Get this, the current lead time for semiconductors is 21.9 weeks. So you order a semiconductor, you gotta wait 21.9 weeks. That's like a little over 5 months. However, that measure only went up a day in the last reading. That's the smallest increase that we've seen in all of 2021. We're starting to see a flattening curve here, an inflection point. And in the past, periods of shortages have typically led to painful periods of oversupply. And so this is where we have to shift from, okay, being worried about inflation, which we're still going to be worried about with wages, but shift to a concern of oversupply. And the concern is that a lot of businesses are actually double ordering right now because they have to wait so long and they're frustrated, so they're double ordering product. And that we might end up seeing cancellations or stocked shelves, and really stocked shelves for quite a while. Not yet, probably got to get through this holiday season first, but we could see and be struggling with oversupply by 2022. So let's try to consolidate all of the madness that we just talked about. Are we in a stagflationary environment? No, not stagflationary. Are we in an inflationary boom? Yes. Do we expect job prices to continue to go up? Yes, absolutely. And ironically, well, maybe not ironically, I mean, expectedly, I should say, the more wages go up, the more unions, like labor unions, get together and demand higher wages next year or the next time a negotiation comes up. So more inflation leading to more inflation, right? Wage price spiral up. Wages go up, input costs go up, prices for products go up, leading people to demand higher wages again. Okay, so inflationary boom with wages going up. Is there light at the end of the tunnel? Yes, and that is with the supply chain crisis. When the supply chain crisis, when and if it goes away, and when we get to a potential area or period of oversupply, businesses are probably going to be tempted to lower prices to clear out inventory, leading to probably amazing revenue indicators, or revenue numbers, I should say, not indicators, like actual revenue results for companies. Because if they start clearing their shelves, even if they drop the price a little bit, and there's a little bit of deflation in products, they're gonna have record revenues because people will see price cuts and go shopping like crazy and continue to spend because, again, savings are up. And circle back Psaki, Jen Psaki, who says that people aren't experiencing inflation because they can't buy anything. Well, they're about to, potentially next year, have the opportunity to buy lots of different stuff. And so that's where maybe and hopefully by the middle to end of 2022, we might actually expect to see prices begin to moderate, if not slow, but fall. They're still going to be buoyed by wages, probably still trying to push up. So we're going to have a little bit of that struggle. And that means we could still see higher inflationary numbers potentially into 2023. But then we expect inflation to finally start chilling out. So was inflation transitory? No, it's been pretty persistent. Inflation's been here and it's staying right now. But there's light at the end of the tunnel. And out of all of this, if there's any recommendation that I would make, hashtag not financial advice, it is, of course, to continue to buy and hodl high quality companies like Tesla, Enphase, Etsy, Apple, Amazon, Lemonade. You can't, in my opinion, go wrong with these very high quality companies. Not financial advice. By the way, right after I filmed this video, listen to this. As I suggested with the stocks that I love, AMD crushed it with earnings. AMD beats on EPS, revenue, net income. Google beats revenue, EPS, margins. Beat. Microsoft Surface sales, like tablet sales went down. Kind of potentially makes sense regarding the chip shortage, but revenue beat, net income beat. Big beats from Microsoft. Enphase, super affected by potential supply chain constraints, right? Beat on earnings, revenue, net income, and guidance, and margin. Mega beats. Visa, more spending than expected, more revenue than expected, and a beat on the bottom line. Folks, if that doesn't convince you that these companies are killing it despite these fears, I don't know what will. Just like you can't go wrong with checking out on one of those amazing programs linked down below for programs on psychology, money, real estate investing, making YouTube videos, sales, stocks, options, technical analysis, you name it, all linked down below. Use that 41% off coupon code, and folks, we'll see you in the next one. Thanks so much. Bye.